Okay, so chapter 7, one of the reasons I skip over this chapter is in this book I'm kind of confused because it kind of goes in a flow where it's talking about money, 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 and kind of easier concepts of money. And then 7 goes to investments and then jumps to computations and credits in chapter 8. And then 9 is business income. But investments aren't necessarily the easiest topic. It gets into some things with capital gains and passive losses and wash sales. And so, yes, it does go on the first page of the 1040. All right, it does go on the capital gains line, but it's not necessarily the easiest thing to understand. So it doesn't go along with the other 2 topics before and after it that are a little bit easier to follow and flow with. So that's one of the reasons I kind of take it out of there and put it in the second half of the semester when we're kind of understanding things hopefully a little bit better. So a couple of the learning objectives that we're going to talk about. We're going to talk about dividend income and investment income, which goes at line 8 and 9, both A and B. And then we're going to look at capital gains. That's where we're going to spend the most of our time. Is talking about capital gains and capital losses and how we can net those 2 things together. We're going to look at the Schedule D and we're going to look at the schedule or Form 8949, which is how we feed into the Schedule D. We're going to look at portfolio investments, passive losses, and then we're going to look at risk losses, and then we're also going to look at wash sales. Some of them things with investments, we're going to look at, talk about before tax rate of return, after tax rate of return. And so that depends on when the investment is taxed. All right? It's the timing. It's a tax strategy. It's a tax planning strategy. And then it depends on the rate at which it's taxed. So not only when, but the rate. And so tax planning all comes down to that after-tax rate of return. And the portfolio versus passive investments, portfolio losses are deferred until the investment is sold. Passive investment losses may be deducted annually. Okay, so portfolio can be deferred until the whole investment is sold. Passive losses can be deducted annually. So portfolio income is usually things like, is usually taxed when it's received. So when you look at interest from a bond or a CD in a savings account, that's something that you will receive. You'll get your 1099 INT from the bank or from the company that you're investing in, and you will put that on your tax return when you get it. All right, it goes on line 1099 8, and it goes on there. It's ordinary income. It's taxed at ordinary tax rates. Interest from U.S. Treasury bonds are not taxable by the state. So they are taxable by the federal government, not taxable by the state. Right. Now, dividends on stock are usually taxable at preferred tax rates. So there's 2 different types of dividends. There's qualified dividends and there's non-qualified dividends. And one thing to keep in mind when you're looking at the dividends is all dividends are non-qualified. Not all dividends are qualified. So when you're looking at a 1040, all your dividends should go on line 9B. Make sure I got that line right. I think, didn't I say last time I gave out, no, wait a minute. I'm looking for a 1040. I got every other form in the world. There it is. All right. Dividend is qualified dividends go on line 9B. Ordinary dividends go on line A. So all dividends are ordinary or non-qualified. All right. All dividends are ordinary or non-qualified. Some dividends are qualified. So all your dividends are going to go on line 9A. All your dividends will go on line 9A. Some of your dividends will go on line 9B. That is one of the most commonly missed things on the final project. Now, again, your final project is different this year. But when it was done before, 9A and 9B were very frequently not done correctly. And it wasn't because you didn't have the right numbers. You didn't put the right numbers on the right lines. Or the right numbers in total. You either subtracted them differently, you didn't put anything on 9B, and you put it all on 9A, or you put nothing on line A, you just put it on line B. If you have qualified dividends, if you have a number that goes on 9B, then you have to have a number on 9A. So that's, sometimes people see, oh, qualified 9B, they don't put anything on 9A. If it's qualified, it is also ordinary. The same kind of goes through for taxable interest, very commonly not done correctly, except for this one is not the same in the sense that if it goes on 9B, it goes on 9A. If it's on 8B, it does not go on 8A. 8B is exempt, so the interest does not go on line 8A. So when we're looking at, so now let's focus just on the qualified dividends. And if we're looking at qualified dividends and we're trying to figure out what would, how this works and what we're going to look at. So usually the preferential rate is 15%. However, if you're normally in the 0 to 15% tax bracket, you're actually going to be taxed at 0. All right? And then 20% if you would have been in the higher tax bracket. And then after tax rate of return, assuming 8% before, is how you figure that out. So why do people invest in this tax bracket? Well, the nice thing about dividends and interest is it's the risk and the diversification. There's not usually a lot of risk when you invest and the dividends come in. The diversification, you get a lot of that. So those factors are not taxed. The risk isn't taxed, the diversification is not taxed. So now let's look at capital gains. Capital gains, we jump down to line 13. These are investments held for appreciation, meaning we're holding them for the purpose of gaining money. We're holding them to gain interest, holding them to get dividends. So stock, land, mutual funds, and then also precious metal and collectibles. Don't see as much of that, but it's also held for the purpose of gaining money. All right, so when we have assets that are held for potential appreciation, we're going to defer their gains for tax purposes. They're generally taxed at preferential rates, and they have special loss rules. These are generally what we call capital assets. Now, capital assets in any other, so we got assets in the trade of business, we have inventory, accounts receivable, and then other types of assets we have are things with inventory like FIFO versus specific identification, long term if it's held for more than a year, and short term if it's less than a year. We won't do a lot of focus when it comes to FIFO and LIFO and the different types of inventory. We're going to focus more on the stock side, and then the book does give a couple examples of the precious metals. Okay, so looking at capital gains, if it is a short-term gain, it will be taxed at an ordinary rate. Right? That is how it works. Short-term gains are going to be taxed at ordinary rates. So pretty much if it's short-term, you don't worry about anything. It's just going to be an ordinary rate, and you don't worry about it. Now, if it's long-term, that's where we start looking at the rates changing. All right? First of all, that's taxed at a maximum preferential rate of 0, 15, or 20. These rates change depending on what it would have been taxed at if it was ordinary. So same as our dividends. The higher tax bracket you're in to begin with, the higher preferential rate you're going to have, with the most being 20%. All right. Now, if you have the sale of the real estate, which we just dealt with in the last chapter, so section 1250, then you're going to be looking at a maximum rate of 25% versus 20%. And then long-term gains from collectibles, that could be up to 28%. But those are things that are a little bit of an exception. And remember when we talked about capital gains, the little bit that we've done so far, we have mentioned that on line 13, the biggest loss you can have is $3,000, right? Okay, so we're going to do the next, okay, so on the board, we have the 7-step process to what we call netting of capital gains. Now, this is also in your book. It is on page, it starts on page, the bottom of page 12. And so, at first, it's very similar, page 12 versus what we have on the screen. It starts off by saying, let's combine all the short-term capital gains and losses. So the first step is to combine the short-term capital gains and losses. So you look at your negatives and your positives from your gains and losses, and that's what you have. Then step 2 says separate long-term capital gains and losses into two separate groups, or into separate groups. 28, 25, and then the other ones combined. And then combine gains and losses in each of those groups. So you're going to net the gains and losses of the long term, but you're going to net them in the 3 different categories: 28, 25, and 0 to 20. And the reason you're doing that is because you're going to tax them at different rates if you have assets in those 3 categories. And then step 3, you're going to figure out how to combine those in each group. And if you look in your book, the reason on the screen it says provides guidance is because if you look in your book, it's much more detailed than that. In your book, it goes through a couple steps. It actually has A, B, and C. Step A says, if none of the long-term group rates from step 2 net to a gain, transfer the loss in the 0, 15, and 20% group to the 28% group and combine it with that loss and proceed to step 4. So basically it says, that's what it's saying, if none of the long-term groups net to a gain, so if you have a loss. If none of the long-term groups from step 2 net to a loss, proceed to step 6, is B. And then at step C is combining the net gains and losses into long-term group rates. And then there's 3 different steps there. So step 3 is looking at 1, which is short-term gains and losses. How did that combine? And step 2, long-term gains and losses. And how did that work? So we're combining those numbers. And then we get down to step 4, and it asks us, if there's no long-term or no short-term capital gain or loss from step 1, we're done. If there isn't, we move on. So reading it can get a little boring. So let's move on. Let's go to the next page, 714. And there's an example. All right. So the example is example 7-7 in your book. And the example starts with, it says we have stock A, B, C, and D. It gives us the market value, the basis, the gain, the loss, short term, and whether or not it's long term. So in the first scenario, step 1 says we net the short term gains and losses. So the first one, we have an $8,000 gain on stock C and $11,000 short term loss on stock D. So why are we netting the $8,000 gain and the $11,000 loss? What makes me net those two? Why am I netting stock C and D together? Why am I not looking at stock A and B?
It's short-term and it's the tax rate that you're looking at.
Exactly. I am looking at the short-term gains. So those short-term gains or losses have to go together. So together, I now have a $3,000 net short-term loss. And that's what, if you look, it actually has abbreviation, NSTCL, net short-term capital loss. All right, step 2 says, now let's look at our long-term gains and losses into rate groups. Both of the long-term transactions are 0, 15 to 20%, so we can keep them together. So we have $35,000 long-term gain and a $10,000 long-term loss. So if we net those two together, we have a $25,000 long-term gain. So that brings us to step 3. So right now we have a loss, short-term loss, and a long-term gain. So step 3, it says step 3A does not apply. Step 3B applies and tells us to skip to 6. So let's go back to 3A and see why it doesn't apply. 3A says if none of the long-term rate groups from step 2 net to a gain, and the net loss group combined with it, then proceed to step 4. Okay, so that does not apply. And then it says B does, 3B applies. It's 3B says, if none of the long-term rate groups from step B net to a loss, proceed to 6. All right, did my long-term rate group net to a loss? No, I had a gain. So let's go to step 6. Step 6 tells us that we are going to, says if there is no short-term capital gain or loss from step 1, the netting process is complete. Well, we have a short-term loss. Then it goes on to say the netting is remaining. So we need to go, if the short-term capital loss exceeds all the gains, the netting process is complete. If the short-term capital loss does not offset the capital gain in any of the long-term rates, the netting process is complete. Okay, well, did my short-term loss offset my long-term capital gain? No. I had a loss of $3,000 and a gain of $25,000. So if I net those two together, what do I have? I have a gain of $22,000. So I have a long-term capital gain of $22,000. So that is the netting process. The netting process is going through, first you combine everything you can that's in the same category, which is gains, right? You take your short-term gains and your short-term losses, and you combine them. You take your long-term gains and your long-term losses, and you combine them. Then you look at your taxes, 0, 10, 50, 20, and then your longer ones, make sure you don't have anything there, and then you net them all together. So that's what we're looking for to try to figure out the process. All right, so here's a question. Ferdinand has the following gains and losses. Short-term gain, $13,000. Short-term loss, $8,000. Long-term gain, $3,000. Long-term loss, $12,000. What is the amount and the character of his gain or loss for the year? What is the amount and what is the character? So what is he going to have a gain or a loss? He's going to have a loss. All right, and we got the loss by calculating. We have a total gain. If we look at our short term, we have a short-term gain or loss.
Gain of 5,000.
We have a short-term gain of 5,000, and we have a long-term
Loss of 9,000.
long-term loss of 9. So if we have a short-term gain of 5 and a long-term loss of 9, we have a net
Loss of 4.
loss of 4. All right, so we combine them. It goes you through the wonderful steps. All right, so we can deduct only $3,000. So that $1,000 we can carry forward. Remember, can we carry anything backwards? No. You can carry forward. And that loss will offset any gains the next year. So if we have a $3,000 gain the next year, we now only have to recognize a $2,000 gain. So remember what I talked about. There are people that will sell stock. It makes tax sense to sell stock at a loss to offset stock that you're selling at a gain. But you got to be smart with it. You can't just sell stock because you want to sell stock to offset a gain. But there's people that are very good on the market will buy and sell stock at losses and gains to minimize the tax effect. And when you can buy and sell at the right amount, then you could actually be making money from both stocks, even the losses, because then you end up not paying capital gains on the ones that you're selling at a profit. All right, so there are limitations, which you should know. Our limitations on capital losses are how much? What can we deduct in 1 year? 3,000. Yes. All right, 3,000. Now, can we deduct personal losses? Can we deduct the loss on the sale of our house? No. All right, between 2008 and 2012, people would have not paid any taxes if you could deduct the loss on the sale of a house. All right, almost everybody's house went down in value. So anyone that sold their house would have had a huge write-off. So that would have been good for people, bad for the government. All right, so gains are taxable, losses are not. And then losses from the sale to related people are definitely not deducted. All right. Now the related person might later be able to deduct it, depending on what they sell it down the road. All right. So it depends on the subsequent sales down the road. Okay. So if you take a look, go ahead and flip past the example that we just used. Now, you should have a copy of a Schedule D. We're not going to look at that right now, but what I just handed out to you is an 8949. In order to do a Schedule D, you have to have an 8949. So based on what we just did with that example in the book, we had the three stocks, A, B, C, and D. If you take a look at page 717, it is an 8949. So if you remember, if you just flip back and look at the example on 714, stock C and D were both short term. So stock C and D are on the first page of 8949. It shows the date we acquired them, the date we sold them, the proceeds from the sale, the cost of the stock, and then our gain and loss. It does that for both stock C and stock D, and then at the bottom, it has the total proceeds, the total cost, and then it has the cost, the total basis, or the gain or loss. And so we had a loss of $3,000. If you turn it to the next page, that is going to be A and B stock. And the difference between the two is the first page is short term and the second page is long term. So if stock A and B is long term, everything else is exactly the same. So you show the full amount, the gain of $25,000, the loss of $3,000. You don't net them together until you bring them together on the Schedule D. The other thing I want to point out, and this is on both pages, at the top it says Part 1, short term. You must check A, B, or C below. A, B, and C for both short term and long term say the same thing. A says that you got to form 1099B, showing the basis. The basis is the amount that is in column E. That basically is telling you, you know how much that stock cost. If you check B, it says you got a 1099B, showing the basis that was not reported to the IRS. Now, that form exists, but I have to tell you, I have not seen it. All right, I have not seen a 1099B issued by a financial institution like a A.G. Edwards or an Edward Jones or I can't even think who mine comes from. All right, that says here's your form. This was not issued to the IRS, but they do exist. Just because it's not issued to the IRS does not necessarily mean you do not have to report it. All right. And then the last one is short-term transactions not reported to you on a 1099B. Right? If you had stock sales, and you know you had stock sales, you are still required to report it, even if you did not get a 1099B. So those are your three different options. Depending on that options, you're going to check A or B. A, B, or C, sorry. Right. And sometimes you don't get a basis. And if you don't, you really want to take the time to research it, because not having a basis means that in column E, you have to put 0. And think about stock C. If I don't have a basis, what is going to be my gain on that stock? They have a basis of $12,000.
$8,000.
Huh? if I have no basis, if I cannot show that my basis is 12,000, and I have to put 0, what's my gain? 20. Yep. So you want to be able to show a basis. It's definitely, you want to be able to show a basis. All right, so then before we do a problem, the other thing that we have is what's called a wash sale. All right, a wash sale is where you buy or sell stock within 61 days of the purchase. So, for example, you could sell stock, and the reason it's 30 days before or 30 days after the day of the sale. So if I buy stock today, what's today's date? November 7th? 8th. So today's November 8th. So if I buy stock today, and then December 8th I sell my stock, a different stock, then that would be considered a wash sale. Basically, what they're looking for is, am I trying to make a profit on stock that I already have? Okay, so here's an example. All right, it's intended to ensure that you cannot deduct losses from stock sales while you're continuing your investment. So if I think my stock is going down and I go ahead and sell it, so then I can deduct the loss, but yet I turn around and I buy the same stock back. So that's why there's this 61-day window. All right, 61 days. So that's 30 days before, 31 days after, right? So it counts the day you're buying it. You cannot buy the same stock that you already invested in and take a loss for the stock that you bought. So how they make sure you don't do that is, take a look at this question. Kim owns 10 shares of Tower with a basis of $40. On December 5th, year 1, she acquires 10 more shares at $30. On December 31st, she sells the original shares for $30. Can she do that?
Yes,
She can?
but she couldn't deduct.
But she couldn't deduct the losses. Okay, so the first question is, what loss can she recognize? And Zaid just said we can recognize nothing. Okay, it is a wash sale. And then the question is, what's the basis in the 10 shares of stock that she has remaining? So she bought 10 shares, or she had 10 shares. What's the basis in the original 10 shares she owned? $400. All right, then she bought 10 more on December 5th. What's the basis in those shares? $300. All right, then she sells on December 31st the original 10 shares at $30. So she still owns 10 shares. What's the basis? 400. Why? You might be right, but why? Because it says she sold the original shares. So that would be the ones that she bought at 40.
She can't come up with a loss, so she's got to hold the more expensive.
Okay. That's kind of correct.
If her new basis is only the 300, then she would have had a $100 loss.
She would have had a $100 loss. So you're right, but let's make sure we get it right every time. So what you're going to do is she can't have a loss. Her loss would have been $100, which is exactly what you said. So what you have to do is you have to increase her original basis, which was you have to increase the basis that she has right now, the stock that she still has. If you remember from the question before, sorry, I went too many. No, it didn't. Hang on. Let me go back up. All right. The stock that she has remaining is the one that she bought on December 5th, and it was 10 shares at $30. So technically her basis is $300, right? Because she sold the stock from before. So what she has to do is take that $300 and increase her basis by $100, the loss that she could not incur because it was a wash sale. So what you were saying is right. We just want to make sure that
They get there the right way.
get there the right way so we get there every time. Exactly. So you cannot deduct the loss. You are absolutely correct. It happened within 61 days. Then you take the basis of the stock that you have that's still existing and you add the disallowed loss to that basis. So $300 plus the disallowed loss of $100. Now, what would we do if Kim would have purchased the stock on November 30th or earlier, or if she would have sold the stock after January 31st of year 2? Would she have been able to deduct the entire loss? Yeah, because then it would not have been a wash sale. All right, now, what's interesting is that there's that 61 days. So if you're smart, you just go 62, right? Is the stock price going to change drastically between day 61 and 62?
Probably not.
Probably not. The question is, are you getting to day 61? A lot of times what happens is you buy stock quicker than that, all right? So that's what you kind of got to try to figure out. So you want to try to avoid that wash sale. Otherwise, you're going to add your disallowed loss back in. So let's take a look at a problem. If you turn to page might have left it on the printer. But let's look at problem, I think it's 44. So 44, we are going to figure out the capital gain and losses for the year based on Matt and Meg.